Most Australian retirees assume tax is something they've left behind, and that assumption is exactly what catches so many people out, sometimes years into retirement, when a bill arrives that simply shouldn't exist in their mind. Today we're going through 5 tax traps that quietly catch retirees off guard. Not because the rules are unfair, but because nobody explained where the lines actually sit. Picture the everyday version of this. You've retired, your super is set up, your pension or part pension is coming through, and life feels settled. Somewhere along the way, you stop thinking about tax returns the way you used to when you were working. Then something changes. You sell an investment property, a term deposit pays more interest than expected, or a super withdrawal doesn't behave the way you assumed. And suddenly, tax is back in the conversation, uninvited. Let's start with the first trap, because it's the one most people get wrong immediately. Superannuation withdrawals after a certain age are commonly tax-free, and that general rule is true for a lot of retirees. But commonly isn't the same as always. Some superannuation funds hold what's known as an untaxed component, often linked to certain public sector or government schemes, and withdrawals from those can still attract tax even once you've reached the age most people assume makes everything tax-free. On top of that, if you access your super before you've genuinely met the conditions of release, the specific rules that confirm you're eligible to withdraw, tax treatment can look completely different from what you expected. Here's what most people don't realize about this one. It's not usually a case of the rules changing on you. It's a case of assuming your own situation matches the general rule everyone talks about, without checking whether your particular fund, your particular withdrawal, or your particular timing lines up with that general rule. 2 retirees can withdraw the exact same amount and end up with completely different tax outcomes, simply because of the fund type or the timing involved. It's worth pausing on this, because the phrase conditions of release sounds like fine print, but it's actually the whole hinge the rule swings on. Reaching a certain age is only part of the picture. The specific circumstances under which you access your super, retiring fully, reducing your working hours, or reaching a particular milestone recognized by your fund, all shape whether a withdrawal is treated the way the general rule assumes. Skipping that check is the single most common reason this first trap catches people who otherwise did everything else correctly. But that's not even the part that surprises most people. The second trap catches retirees who did everything right with their super and still end up with an unexpected tax bill from somewhere else entirely. Investment income, shares, rental properties, bank interest, and managed funds don't stop generating taxable income just because you've retired. Dividends from shares, rent from an investment property, interest earned on savings, and distributions from managed funds are all treated as income in the eyes of the tax system, regardless of your age or your retirement status. It's easy to assume that once the paychecks stop, so does your tax obligation. But investment income keeps flowing whether you're working or not, and it keeps being accessible the whole time. Think about what that looks like in practice. A retiree with a modest share portfolio and a rental property might genuinely believe they're living off retirement income in a tax-free bubble. In reality, every dividend, every rent payment, and every dollar of interest sits inside their taxable income for the year, and depending on the total, that can shift their overall tax position more than they expected. Now here's where things get more layered, because the third trap often arrives at the worst possible moment, when you decide to sell something. Capital gains tax applies when you sell an asset like an investment property, shares, or certain other investments, and that asset has increased in value since you bought it. A lot of retirees plan to sell an investment property or a share parcel specifically to fund retirement without factoring in that the gain itself can be taxable in the year of sale. It's not a punishment for selling, it's simply how the system treats profit on an asset, whether you're retired or not. The next part is where most people get caught out. Timing genuinely matters here. Selling an asset in a particular financial year, alongside other income you're already receiving that year, can push your total taxable position higher than if the sale had happened in a different year or been structured differently. This isn't about avoiding tax altogether. It's about understanding that when you sell matters just as much as what you sell. Here's the fourth trap, and it's one of the most confusing for retirees specifically, because it sits at the intersection of two completely different systems. Certain income, investment earnings, part-time work, or income from an asset sale can affect both your tax position with the Australian Taxation Office and, separately, your eligibility for the age pension or other Centrelink payments through Centrelink's own income and asset tests. These are two different assessments run by two different bodies using two different sets of rules. Yet the same dollar of income can influence both at once. A lot of retirees only think about the tax side, assuming that if something isn't taxable, it won't affect their pension either. That assumption is often wrong. Income and assets can affect your pension eligibility even in situations where the tax impact is minimal, or the other way around. This is exactly why understanding the difference between taxable and assessable for Centrelink purposes matters so much. They overlap, but they're not identical, and conflating the two is one of the most common mistakes retirees make when trying to plan around both systems at once. It helps to think of it as two separate officials looking at the same event through two different lenses. One is asking whether this dollar counts toward what you owe in tax. The other is asking whether this dollar affects how much pension you're entitled to receive. Both questions are legitimate, both are being asked about the same transaction, and getting a clear answer to one doesn't automatically answer the other. Here's the fifth and final trap, and in some ways it's the most costly one. Because it's not about paying tax you didn't expect. It's about paying more tax than you needed to. Many retirees fail to claim tax offsets, deductions, and credits they're genuinely entitled to, simply because nobody flagged that they existed. Offsets specifically designed for seniors and pensioners, deductions related to managing your investments, and credits tied to specific circumstances can all reduce what you owe, but none of them apply automatically. If you don't know to claim them, or your tax return isn't prepared with your retirement circumstances properly considered, you can end up paying full tax on income that should have been reduced. Let's walk through how these 5 traps play out for 2 different retirees in similar situations. Picture someone who retired assuming their finances were now essentially tax-free. They didn't realize their fund had an untaxed component, didn't track their investment income carefully, sold a rental property without considering the timing, didn't connect the dots between their asset sale and their pension eligibility, and prepared their own tax return without checking which offsets applied to them. Come tax time, they're facing a bill considerably larger than expected, along with a Centrelink review they didn't see coming. Now picture a retiree in a nearly identical financial position who took a different approach. Before withdrawing from Super, they confirmed with their fund exactly how their balance was structured. They kept a simple running total of investment income throughout the year. Before selling their rental property, they spoke with a tax professional about timing the sale to suit their overall financial year. They asked specifically how that sale might interact with their pension assessment, and they had their return prepared by someone familiar with retirement-specific offsets and deductions. Same assets, same general situation, but a considerably smoother outcome, purely because each trap was checked before it became a problem. So here's what you should actually do with this. First, before withdrawing from Super, confirm directly with your fund whether any portion is untaxed and whether you've genuinely met the conditions of release. Don't assume based on age alone. Second, keep a simple running record of investment income throughout the year rather than trying to reconstruct it all at tax time. Third, if you're planning to sell an asset like a property or a share parcel, talk to a tax professional about timing before the sale happens, not after. Fourth, whenever a significant income event is coming up, ask specifically how it might affect both your tax position and your Centrelink assessment, since they're assessed separately. And fifth, Use a tax agent or accountant who's familiar with retirement-specific offsets and deductions, rather than assuming a standard return will automatically capture everything you're entitled to. None of this requires becoming a tax expert yourself. It simply requires knowing that these 5 areas exist and asking the right questions before decisions are made, not after the bill arrives. There's one more habit worth building on top of these 5, and it ties everything together. Once a year, ideally well before tax time, sit down with a full picture of your situation, your superstructure, your investments, any planned sales, and your Centrelink status, and review it as one connected system rather than 5 separate conversations. A tax professional who understands retirement specifically can often spot an interaction between 2 of these traps that you'd never think to connect on your own, simply because they're used to seeing how these pieces affect each other in practice. Here's the core of it. Retirement doesn't remove you from the tax system. It changes which parts of it apply to you and how they interact with your pension. Check your superstructure, track your investment income, plan the timing of any sale, understand how tax and Centrelink assessments differ, and make sure your return captures every offset you're entitled to. Do that, and these 5 traps stop being surprises and start being simply part of a plan you're already ahead of. If this helped you spot a trap you hadn't considered, consider subscribing so you don't miss the next one we break down. And if you've experienced one of these 5 yourself, share it in the comments. It might help someone else avoid the same surprise.